As part of our mergers and acquisitions, it could involve a merger or an acquisition of a high growth startup company. Now, the difficulty that we face there is trying to value that business. Before we start looking at valuations and numbers, let's just see why that might be the case as regards to why it's difficult to value the business. I think one of the key aspects that you can possibly think about if you're looking at a startup business is the fact that it could or very well be a loss-making business. Now, if you're making losses, it's going to be very difficult there to go through and use, say, a PE ratio method of valuing that business. There are other alternatives, however, which we'll see shortly, is that we could go through and maybe try and convert that loss back into a cash flow. It could be that there are one-off costs that we've incurred. Maybe there's some high depreciation, maybe there's some impairment of assets, maybe there's some form of adjustment that we can make to convert that loss back into a positive cash flow. Losses don't necessarily mean that we have a negative cash flow. We could have a positive cash flow after we've taken account of any accounting adjustments. Other reasons that we could potentially have as to why it's difficult to value a high growth startup business is that you've got a lack of a track record. You haven't been involved in the business for all that long. You don't know the market all that well. So it's very difficult to go through and think about what your options are for the future and what your growth will be. Likewise, it could be a new product that is being started up by this business. If it's a new product, you don't know what the uptake will be. It's very much untested as you have a lack of a track record. Again, if you're new into the market, you're going to have there the fact that you won't have that much presence within the market. You won't be able to go through and dominate the market, set prices and hope that the customers will come. It will be very much dictated by your customers as to what you're going to sell your product at. And what you need to go through and do, there's a couple more points there that you can take on board, but within any exam question, always look at the detail, read the question and ensure that you can pick out the specifics to the scenario as to why it's difficult to value that business. If we're to put a numerical valuation on this high growth startup company, we said that it could be loss making, so it would be difficult to use your PE ratio. However, what we can do is look at a discounted cash flow technique by looking at the cash flows into the future and discounting them back to present value. However, the issue that we have is if we look at an inflating perpetuity, taking your cash flow divided by your cost of equity less your growth, the issue there is that we don't know what the growth will be, because there you are predicting the growth into the future. If you're a high growth startup company, you're unlikely to have gone through and paid any dividends. Why is that then an issue? Well, if we're looking at G, we can go through there and look at that using Gordon's growth model. Now remember, Gordon's growth is there as your return multiplied by your retention. So return multiplied by your retention, R multiplied by B. But what we've got there in terms of your retention, well, that there, if you're a startup company, is likely to be 100% retention, because you're not going to go through and pay out any dividends. So therefore, your retention there is going to be 1. So when we look at the growth rate, your growth is very much based upon the return that we expect to generate in the future. So let's go through and work it with a numbers example to show how it fits together and show why it's very difficult to value a high growth startup company. If we look at this example here at Bednar, what we're trying to do is value a high growth startup company. Information that we're given within the question is that we've got a cost of equity there of 20%. And what we've got as well is it goes through there and tells us what the costs are at 1,200 million for every single year. And they're going to grow at 4%. We're also told as well that the revenues that we get into the future are 320 million. And the important bit of information that we're given within this question is that we're going to generate a return on those funds of somewhere between 16 and 18%. So what we can go through and do is look at some discounted future cash flows, looking at those different growth rates that we have for our revenues of 16 and 18%. So what have we got? Well, if we go through and look at Gordon's growth model, R multiplied by B, as it's a high growth startup company, and as we're told in the question, we're not going to pay dividends for the foreseeable future, then there, your retention is 100%. We're keeping back all the profits in the business. We're not paying out a dividend. So there, my growth is going to be either 16% or my growth is going to be there at 18%. And that's looking there at the growth in our revenues. So when we're going through and looking at our cash flows, remember the present value is going to be your revenue that we had of 320 million divided by KE, which is there 0.2, less G, whereby G is going to be 16% and then G is also going to be 18%. We'll get two different valuations. In terms of going through and looking at the costs, if we're looking at the present value of the costs, we have 1,200 million divided by your cost of equity at 20%, so 0.2, less your growth at 4%, so 0.04. So the present value of your costs works out at 7,500 million. What I'd like you to go through and do is just tap away at the numbers on your calculator, work out the present value of the two different revenue streams for the growth rates, and then work out what the value of the business is to see your maximum and your minimum value. Have a go, see how you get on. So, how did you get on? Managed to cope with that okay? Yeah, good. So some nice easy numbers and some discounting to get you back into the swing of things. So what you've got there is if you look at the present value of the revenue based on our 16%, you've got your cash flow of 320 million divided by your cost of equity less your growth, 0.2 minus 0.16. That goes through and gives you there the present value of your revenue at 8,000 million. And then to work out the overall value of this company, you subtract the present value of the cost from the present value of your revenue to give you £500 million. Now, if we go through and compare that to looking at a growth rate of 18%, we can see that there's quite a significant difference. You've still got your revenues at 320 million, that stayed the same. Your cost of equity didn't change, that was at 20%. But the key is that the growth rate on those revenues is now deemed to be 18%. With a higher level of growth, that gives us a much higher present value there at £16,000 million. If we go through there and deduct the present value of the cost from the present value of the revenues, that goes through there and gives us £8,500 million as the value of this startup company. Which if you compare that to what we had before of £500 million, that's an £8,000 million difference. That's enormous, just based upon an ever so slight change in my growth rate from 16 to 18%. So all it would take is a slightly incorrect estimation of the growth in the future of your high growth startup company to ensure then that you have the wrong valuation of your company. A big risk is overpaying for the value of an acquisition. We don't want that to happen, but that's one of the big issues that you have in this scenario here.